first half of 2023 is in the books, and to the outside observer, it has been an incredibly strong start to the year. After climbing over 7% during the first quarter, the S&P 500 index rose another 8% during the second quarter for a year-to-date return of over 16%. Performance for other popular market indices for the quarter are as follows. The NASDAQ was up over 13%, the Russell 2000 came in at 5.2%, and the Dow Jones Industrial Average rose 4%. Beneath the surface, performance has been more difficult. The first half of the year has been dominated by the tech heavyweights. For example, technology was up 42%, communication services up 36%, and consumer discretionary up 32%, while the average S&P 500 stock ex technology was up just 5%. Energy, utilities, healthcare, and financials were all down year to date. Performance has also been very top heavy. The largest 10 stocks in the S&P 500 are up 65% year to date on average. It's estimated that over 80% of the return for the S&P 500 year to date can be attributed to the top 10 technology stocks. While this is concerning, the technical backdrop has become more supportive as of late. I do believe participation needs to broaden out for the market to continue to move upward. A few other observations before transitioning to fixed income. Despite the banking sector woes that carried into the second quarter and the debt ceiling negotiations, volatility has been unusually low this year. The popular VIX index dropped below 16 for the first time since November of 2021. Furthermore, there were only 3 trading days in April where the S&P went up or down by more than 1% on any given day. The S&P also posted its best quarter since the fourth quarter of 2021. Strong earnings and resilient economic data led to the strong quarter. Small companies, as defined by the Russell 2000 index, rose for the third straight quarter. But it was also the third straight quarter that smaller companies trailed their larger brethren. The technology-laden NASDAQ, which is up over 32% year to date, had its best start to the year in over a decade. After the recent rally, the S&P 500 index is up over 20% from its October 2022 low, technically marking the start of a new bull market. It took the S&P 500 165 days to reach this milestone from the bottom, which is nearly 2 times the historical average and the longest period since the 1950s. Turning to fixed income, the Bloomberg US Aggregate Bond Index declined for the first time in 3 quarters, returning a return of almost 1% negative. Fixed income declined as interest rates increase as expectations for a more aggressive Fed tightening cycle amidst the resilience of the US economy offset the continued decline in inflationary pressures. In fixed income, it was evident of a risk-on environment as high-yield bonds increased in value. The risk-on environment in stocks carried over to high-yield bonds as the asset class rose for the quarter. Spreads declined as a result of the resilience of the economy and stronger earnings from energy companies. High-yield spreads are something I watch closely as they tend to be a good indicator of market and economic conditions. Please contact me if you have any questions. Thank you for your trust in us. day.